Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets. We have a special guest, Eric, with us here today. Tori and Miles signing back on, and we're going to hand it right to you, Miles, and get us started with gold.
Thanks, Tori. I appreciate it. We did come back to that 382 fib last week that we discussed. Not a very strong pullback, which is why we were a little 50-50 on could we dive a little deeper. Well, apparently we haven't. We're back up over 1,300. So we're looking at a couple levels above here, 1,326, a little interim failure to return to the previous high. Then the previous high, 1346, another $20 higher, go $20 above that at we're at the last 5-year high, 1365. So it's possible we could see gold continue to push up here. If we do, that's an incredibly strong move on gold's part, having not come back down below that 382. I like a 50%. I like the 682 fib, not coming back that far down. Definitely adds a little bit of strength to the gold argument, especially with what the dollar's been doing, which we'll get to here in a minute.
So, Miles, what is it about that 1365 number that you do like or dislike?
Eric, it is a good question. For the last couple years, we've been talking about this pretty persistent resistance level that we keep bouncing up against. We go up to 1365, we drop down to 1100. We go up to 1365, we drop to 1200. This time we go up to 1365 and we push just below 1300. So eventually that's that high point that we expect to break above, and then we start looking at the longer term charts where we start looking for where that next resistance level could be 100, 150, maybe $200 higher than where we're at now. So the 1365 number, you've got a lot of people playing defense there who are holding short positions or looking to cash out at profit just because we've had so much history at that price. So it does matter when we see these long-term prices keep getting hit over and over again over extended periods of time. And when you finally push above or below something like that, these massive multi-year trend lines, then you're probably switching directions, either the bulls taking over in this case, or at the top end, bears taking over. So we'll be excited to see the big term breakout that we've been hoping for the last couple years that we've been doing this show. We knew it was coming, and it appears it might be just around the corner.
It's amazing to me to hear you say that that's the 5-year high. It's just after witnessing everything that took place from 2007, 8, all the way through 11, even where prices were in 2012, that's a 5-year high. So it would be cause for celebration for sure. What about silver?
Silver, like it tends to do, is lagging a little bit behind gold in these early stages of the bull market, but the movements are more volatile, are deeper. So where gold only came down to its 382, the silver position came all the way down to the 618 fib, right at the top of the previous high before we turned arguably short-term bullish. So I think a move back up to about 1620, that high from earlier this year, is pretty likely. We need to push above it to where we're getting back up into the old highs from, beginning to middle of 2018. We could be seeing the makings of a head and shoulders pattern, an upside down head and shoulders here, which I'll draw on the chart, possibly playing out. 1620 move back down to the 15s, and then eventually we break through. So there's a couple options in silver here coming over the next few months. Should be interesting to watch this play out. Obviously, if gold continues up, silver follows suit, and we're looking in the mid-16s, maybe even up into the 17s in silver as gold pushes up above 1365 towards 1400.
Yeah, I appreciate that too. What we've also seen here lately is the volatility in silver, which changes the ratio. So Eric, maybe you want to speak to this a little bit, but to the upside, silver outpaces. Unfortunately, to the downside, silver outpaces. But we've shrunk that ratio from 85 to 1 down to 84 to 1 just in a week. And that, again, is really our primary focus, is that ratio.
And the reason that, we follow these ratios so closely, not only does it show us where the better value in the market is, but we're not just silver fanatics here. We're buying silver now because you're paying pennies on the dollar for your gold later. We're going to swap out of that silver when the ratio corrects. You gain free ounces of gold, and voila, discount done.
Likewise, if you have to be freeing up any cash by liquidating metals, you certainly want to be leaning more on the liquidation of the gold side rather than the silver, because you don't want to be selling silver at such a drastically undervalued stage. So, Miles, what about the other white metals, platinum and palladium?
I gave 4 potential bottoms, correction levels on the platinum chart during our last show. We only came into the first one, 815 at the 618 fib, and have bounced up pretty hard from there, back above the 382. So you can see on the chart here, my guess would be we're probably stair-stepping back up to retest that 875 high for a third time. Eventually, we push above that. We have our rising floor, so it's very likely the pressure will keep building on platinum, pushing us above that 875 number up to 900, which would be our next, both psychological with the double zero as well as some price action from previously last year. And then from there, we're going to look at those early 2018 highs. So platinum obviously has a ways to go. However, when it moves, and you can see even here just in the last couple weeks, we've had some pretty substantial up and down. So I think once we get up to those levels and break above, platinum could jump up back to 1,000, 1,100 pretty quickly.
Well, with that price movement you're describing too, Miles, we've actually seen platinum a little bit outpace palladium, even though palladium has remained strong. We don't care if they both go up. It's, again, as Eric pointed out, looking for relative value. We just need platinum to outpace palladium. That's the most important thing. So, for example, today alone, platinum's up 1.2% in a single day. Very strong. Palladium's up 0.6%. So twice the move, just like what we've seen in silver on some days. If we can get double the percentage move on a consistent basis, those are the things, those are the price movements that change ratios.
Speaking of palladium, it's starting to look a little bit toppy here, like you said, not coming back up as much as platinum did after going parabolic over the last few months. I mean, I really think it needs to run out of gas. Even if it does continue going up, I think it's very likely we could see palladium run out of a little bit of that steam it's had for the last number of years and let platinum play that catch-up game it absolutely needs to. So hopefully here we'll see some semblance of a ceiling on the palladium price, at least short-term enough for platinum and some of the other sister metals like iridium to play catch-up in that price movement. However that ends up playing out doesn't really matter because I'm not buying palladium right now. I'm just buying platinum. So however that ratio wants to work out is fine with me.
Yep, I agree. So let's transition over to some of the fundamentals, starting with central banks. We do have an FOMC meeting minutes released next week, Wednesday the 20th. And just like we mentioned last week, we cannot imagine a rate hike at this point. A lot of the economic numbers are actually okay this week, which I'll get into in a little bit as well. There's still not only a rate hike probably off the table, quite honestly, but there may even be some pressure to see a cut. And again, I think it's too early this week, but that's the sort of numbers. Inflation has been so low here in the first quarter of the year that I think with the Fed balance sheet shrinking so aggressively as well, and them seeing the economic strains that are really coming out of Europe and out of Asia, they know they just can't afford to do it right now. So don't expect a whole lot of action out of next week's, but certainly we'll have a show on the day of the release.
And Tori, what if Jay Powell comes out and shocks us all and does cut rates? What immediate reaction are we going to see in the metals from that?
Well, logic would tell you, that's a great question. Logic would tell you that gold should rally because that's weak dollar policy, right? That means, look, they're going to try to flood the market with more dollars. They want cheaper dollars. That should weaken the dollar, and gold should climb as a hedge to the dollar, right? That has not been the case on the opposite effect. So the previous rate hikes that we've actually seen have resulted in gold responding favorably, right? We've talked about it on this show where we've seen $10, $20, even $30 jumps in subsequent days following rate hikes. And that's really counterintuitive because you would think that being strong dollar policy, that would actually cause the dollar to climb and gold to drop. That really has not been the case. So you could argue that, as they slashed rates all the way down, the dollar certainly fell along with that because that's weak dollar policy. And they're trying to get a competitive advantage in the world. So I really suspect that gold would rally as a result of that. Not only would the dollar turn down softly, gold would respond to that, but I think too that it would be an indication that they're very concerned about not so much inflation, obviously, they're concerned about economic downturn. And so I think that the ripple effect would be an increased flight into the gold metal.
Tori, that makes a lot of sense, and I think a lot of what we saw with the rate hikes last year with gold jumping up was the pressure that put on the equities market. And now with the cuts, that's going to kind of give a little bit more juice to the equities market, but put some down pressure on the dollar. So I'd kind of pass that off to you, Miles. We saw the Dow transports down for 11 days in a row. What will this rate cut do there, and where do you see that going?
Yeah, the transports are something I find fascinating, going back to the old Dow theory concept. I mean, a couple weeks ago we mentioned the industrials, the Dow that everyone really tends to look at, had been going up pretty strong, but the transports had been lagging behind on top of that. So we speculated that if the transports aren't leading this market, we should see things turn back down. Lo and behold, the industrials come up to a fib level. They come up to a previous low from that old left shoulder we had. The transports have turned down strong. The industrials have turned down strong. And I think the industrials may be coming back below 25, maybe 24.5 on the downside. We've got the US dollar that's flattened out over the last 6-8 months. So what do the people react to? And obviously that was Eric's question a minute ago. What do the people react to if they raise and or lower interest rates? And if the equities market is coming down, that may open the door for them to lower those interest rates again, make money easier again, to try to juice the system like they did. And that's going to be pretty nasty for the US dollar, but exceptionally strong both for precious metals and pushing the equities back up.
Yeah. Keep in mind, if everything was rosy, we would see the Bank of Japan raising rates, right? We would see the European Central Bank raising rates. So they all know what they cannot afford to do. The United States and our Federal Reserve has been the one exception in the world, really, with being able to raise those rates. And we know that they're doing it because they're trying to put the arrows back in the quiver of being able to lower rates in the instance of an economic recession or crisis. And so I think it's far too early for them to even be discussing it because they still want to raise further. That being said, you are seeing a lot of reaction in the market. And that Dow transport decline, that 11 days, was a record 11-day decline. So there's no way that Dow was going to sustain its climb that we saw. And there was no way that gold wasn't going to get a little bit of a boost. Okay, it's not just coming from technicals. It's, again, coming from the fundamentals. Well, you've also got oil in the markets right now, $58 a barrel today, and we mentioned that. That's up 3.5% just since last week's show. And the volatility continues there. You were down October to Christmas 44%. Since then, you're up 38%. So anyone playing with oil futures is probably pretty happy, unless they were on the wrong side of both of those moves. But that's going hand in hand with gold, okay, and the counter to some of the things you see in the equities markets. A lot of other things to react to. A lot of news out this week. This is a record week in another way, and that's just with key economic reports out. And John Williams from Shadow Stats does a great job of summarizing what those are this week as he talks about the fact that, look, real unemployment is 21%. If you take out long-term discouraged workers and displaced workers, the real state of the economy, again, is not that good, 21%. But here's some key economic reports out this week. You've got U.S. retail sales, right? They came out earlier. They were unchanged as expected, but they did revise December down. February consumer price index, right? The prices that we're paying for things edged up slightly, 0.2%. That's mild inflation in their opinion. February producer price index, Miles, this goes really with what you're talking about with the transports, okay? Edged up only 0.1%.
And was lower than expected.
Lower than expected. So that's, again, not a healthy economy. And a lot of that, again, has to do, too, with things going on across the pond. And then we've got durable goods, new orders. Like how many things are people actually ordering for future distribution? That actually isn't too bad.
But was lower than expected.
And it rose for the third month in a row, but that's mostly domestic demand. That is not the international demand. It's actually slowed in the international arena. So we've got a few new ones to come out as well. Construction spending in January, that one was strong. Okay, in the U.S. housing market, we continue to see construction spending pick up. That was up 1.3%, and that's actually the biggest gain in 9 months. I don't think that'll be sustained, especially if they get to a point where they can start hiking rates again. So we got two more: industrial production, new home sales. Just think about all that news and then think about why the markets are doing what they're doing from a seesaw perspective. And again, especially with gold, that's why there's a lot of reaction in the markets.
And kind of to wrap up today's show, there's just a few geopolitical events that we think you should keep your eye on that could have an effect on the metals market. You got Trump turning his trade attention towards India and Turkey. China is still unresolved as well. You've got this new hostile development between India and Pakistan. You've got Venezuela, who just now hit over 2 million% inflation, as these guys talk about frequently on the show. You've also got the no-deal Brexit vote rejected again today.
Between the rest of the economic indicators over the next week, the Fed announcement next week, a number of political, geopolitical events taking place, I'd expect a bumpy ride here through the end of March. So listener, investor out there joining us each week, thank you for stopping by. Certainly pay attention to your markets, to your investments over the next few weeks, because like I said, I would expect things to be rather volatile, not just in the metals, but in other markets as well. So as always, we thank you for stopping by to Golden Rule Radio. If you like what you heard, click the subscribe button, ring the bell, head on over to Facebook, McIlvaney Financial, Twitter @ICA Gold, our website, McIlvaney.com, or give us a call anytime at your convenience, 1-800-525-9556. Thanks for listening.
Have a great week.